Welcome to the BFI Crash course. What you're going to learn is who BFI are, how they operate, what a BFI footprint is, how to identify it, and also how to execute on it. Let's get started. So you probably have already noticed I have these two pictures up on the screen. So before we do anything, I'd like you to just maybe take a screenshot of these, save them, because you're going to need them later. I'm going to take them away from the screen here. But this is the structure in which we operate. Okay, you're primarily only going to be focusing on these four structures here. So it's a rally-based drop, drop-based rally, drop-based drop, rally-based rally. So you're going to learn how to identify this properly and how to execute on it. The logic behind this method comes from a Wyckoff logic. Okay, so you're going to gain more understanding on how to use this right here to your advantage and how to execute on it. So go ahead and save these and put them in a safe spot for later, because I'm going to take them away from the screen and we're going to get started. Okay. Okay. So who are BFI? BFI, what that stands for is Bank and Financial Institution. They control the majority of all markets. They're the ones that make the price move or not move. So what you're trying to do is essentially you are trying to mirror their orders. Every single trade that you've ever been involved in that you won or lost is because of BFI, not because of anything else. Okay? They're the ones that control the price. They are what we call dynamic traders. They have the power and position sizing to influence the price to move. We are passive traders. We do not have that power, and what we're trying to do is mirror their orders by identifying where they are positioned, what they are doing at that position, and essentially copycat what they're doing, ideally right before they do it. Okay? All right, let's get started. First things first, before anything else, you have to understand what a BFI footprint is. Okay? A BFI footprint is a large price move, or a healthy price movement that covers a decent amount of distance with volume, that has a strong impulsive move, if you will, that has a strong impulsive move. This would be an example of a BFI footprint. Okay, this would be an example of a BFI footprint. And the origin of the BFI footprint is obviously where it stems from. Now, how we draw our zones on a BFI footprint. Now, this would be in the middle of, say, a weekly chart. This is one BFI footprint, and we would go from here, from the base to the wick. I already got a couple lines there. And the way that you want to trade a BFI footprint, above all else, no matter what time frame you're trading on, is you want to go from the very first retest of the origin of that footprint. Okay, the very first retest of that origin. Now that can be long or short, doesn't matter, but the first retest of that zone is always going to have the I shouldn't say always. It has the highest probability to have the strongest response. Okay? The highest probability to have the strongest response. All right? Because the orders that are sitting there where they took their position, whether it be long or short, goes both ways. And I'm going to give you guys a few examples on how to do this. Those orders are fresh. So let's say, I don't know, let's say we have 10,000 orders. Obviously, I'm using a much smaller number. We have 10,000 orders down here, right? And it made this first move, and maybe they utilized, say, 3,000 orders down there. So they have 7,000 buy orders floating, still sitting there waiting to be executed. So when that price returns to that origin, those orders are sitting there in the form of limit orders. Okay? They're sitting in the form of limit orders. So when that price returns, the limit orders are executed, and BFI is they activate the buying process or selling process, depending on which way they're going. Okay, so but the reason why the first retest is so important is because the orders are fresh. So even if you are, let's say, even if you're going long here, right? And maybe this chart is going to have a continuation to the downside. In this case, it obviously did not, but let's just say it was going to have a continuation later on. By taking the first retest, you're likely to at least experience a pop or pause, enough of a move, ideally, that you can at least find out where it's going to go, if it's going to have a full move back from A to B and do it again, A to B, back up here to the top of that impulsive move. Okay, so that's why you want to take the first retest, not the second, not the third, not the fourth. And the problem with a lot of retail traders is they will wait and hesitate, and they will not take the first retest, buying at the level. If you notice, just in this one example alone, this may look a little scary to you. This may look a little scary. I mean, look at how aggressive and fast the price is moving, right? You may be there on intraday and see this closing violently all the way down here, so, essentially sweeping these orders earlier from that's the 24th of April, right? And that would have been the exact time that you want to buy, right? And BFI know that. They operate like this on purpose, okay? So whenever you have a BFI footprint, again, it's going to be base to wick. You're going to be operating on the 4-hour chart, okay? 4-hour chart. Now this is more like a weekly time frame, where I'm looking just for a single impulsive move from A to B. Things you also have to realize that BFI operate on very, very high time frames. So the bigger the zone, when I say the bigger, the higher the time frame, perhaps is the better way to put it, the higher the time frame of the zone, the more powerful it is. Okay, the higher the time frame, the more powerful it is. Now, I want you guys primarily operating on the 4-hour time frame, and you're going to be taking signals on the 15-minute. Okay, so your two charts, if you were lining them up side by side, you perhaps have a 4-hour chart on one side, 15-minute on the other, and you'll be looking for your signals on that 15-minute chart. Okay, now, like I said, this is just a simple A to B movement on the first retest of this origin. This would be like more of a weekly view. Okay, when you guys are doing your analysis, like I said, you want to be on your 4-hour chart. How you determine what is the difference between a high and low probability trade, that's going to be found on the monthly order flow, or the monthly chart, sorry, the monthly chart. Okay, so you can zoom out a little bit to the monthly, and you can gain an idea of what you could expect. Okay, I love the monthly chart. I love the monthly and the weekly because it's very, very, very clear. It's very clear. Okay, and the same rules apply. The same rules apply to the 4-hour chart as they do the monthly. You can notice right now, just by looking at this chart, that BFI are obviously protecting a position here in this 380, 390 range. You can see I already have some levels sitting down there, right? And I got some supply levels up here at the top, etc. And this is also why this is suited for the professional trader who has the patience to sit and wait, because these prices, they're not necessarily going to show up every single day. This is not a day trading strategy. This is a swing trading strategy. Okay, swing trading strategy. You need to be, if you're trading derivatives, you're trading options, you need to be buying time on these contracts. Okay, when you're just getting started, in my opinion, 3 weeks, 4 weeks at a minimum is necessary. If you're having me guide you we may be doing a little bit shorter time frame, but for the most part, all of our swings, they're going to have a minimum of at least 2 weeks. At least 2 weeks on a contract, okay? So anyways, coming back to the monthly. The reason you want to observe the monthly is because whatever the direction of the monthly order flow is, it will most likely continue that direction for the entire month. Okay, so if your monthly order flow is short, it's most likely going to be a short month. Okay, if your monthly order flow is long, it's most likely going to be a long month. Okay, and you will look for those long setups within a month that has bullish order flow, if you will. Okay, now going back to looking at zones, monthly zones are very rare that they're going to break. Okay, so you should always have a gauge of where those monthly zones are at all times. Okay, very rare, because once BFI establishes a position, like in this particular scenario, once they broke this price here above this, say, 382 mark, notice what happened when that price pulled away from it and it came back to retest that breakout level. Look what happened. They added and protected their position. Okay, and if there's one thing that BFI likes to do, they love to add to and protect their position. If they had a tattoo, it would be written all over them. Okay, so I want you to write that down in your notes. Add to the position, protect the position. Add to the position, protect the position. Okay, they're always going to be doing that at all times. Now remember, they are also naturally long and short at all times. They're long and short. That's how they operate. Okay, but in the end, they're always going to be long, especially on high quality companies. So in the order of probability, from the 4 structures I gave you at the beginning of this video, the drop base rally is going to have the highest probability. Okay, the next one is going to be a rally base drop, and then following that is going to be a rally base rally, and then a drop base drop. That is the order of probability of how those trades, that's how they're going to play out, if you will, if you were to stack them up against each other in terms of probability. All right, so coming back to monthly, again, same thing. It's going to be base to wick, just like this. Base to wick up here in the top, down here. Now this is a breakout level, right? So this is going to be a breakout. When you have something like this that looks a little bit more, you don't get as clear of a base to wick type setup on the monthly, that's when you would reduce down to the 4-hour to get a little bit better gauge of exactly where that impulsive move took place. Okay, so when it's not as clear on the monthly, like this doesn't really have much of a wick, you can't draw a zone there, that's when you would go down to the 4-hour, sorry. So I always want you looking at the monthly though, just to set your zones, keep them in mind. Again, they're very rare that they break, especially to the downside. The markets are naturally long by default. Okay, 80% of the time, if you have a long position, it's most likely going to work. Okay, all right, let's move forward. Let's get back into these footprints. Okay, we'll stick with this one example here. We can get started here. How you're going to be in terms of entry, how to execute on this. Okay, how to execute on this. What are you going to be looking for is probably the question. So we'll just go back to this. What was that, April? So now we're on the 15-minute here. Okay, here we go. All right, what you're going to be looking for. Ideal situation. Let me get the volume going here. Volume and volume profile. You're going to want to have both of those on your charts. Okay. Ideal situation is when it enters the zone, you're taking what I call a pilot entry, especially if you're trading options. Entry into the zone, the deeper half. So if you were to take this zone and split it in half, like so, an entry with a pilot position, so that's a partial position in the deep half, it's always a good way to start it. In this particular situation, you didn't get a very clear signal in terms of what would cause a pivot, right? But the following day you did. The following day you have a signal. So the best thing that you were looking for on the 15-minute chart is exactly what showed up in the first 15 minutes of the day. It's what we call a high volume pin bar. Okay, it's a high volume pin bar. And now you have this structure that's developing that I showed you at the beginning of the video. You have a drop, you have a base, and then it is followed with a rally. Okay, it's followed with a rally. So when the price enters the zone at the origin of the BFI footprint, you want to be taking an entry. Ideally, it's with a signal that looks like this. In this particular case, it just didn't show, but you got one the next day. So when you see that signal, that's when you want to start trailing in and getting into your position. Now, you may be asking me, okay, you took a pilot entry. Now, some people, they want to go all at once. That's a lot of retail traders do that. In my experience, I would recommend that you scale your entry on a swing trade. Okay, you scale your entry, and the way you're going to scale those entries is the initial entry is perhaps would feel like that may feel like it's the highest risk because it's going to be in the deepest part of the zone, and you're going to be looking at that price. It's going to be a price that's you're not mentally, you will look at it and say, I probably wouldn't want to buy here, and that would be, again, the exact price where you would want to buy, right? So I like to scale the entry. I found that to be very, very helpful, because when you scale an entry on a swing trade, if this trade were to continue sour and it didn't work out, you're only partially in. But also, if it decides to base longer or sweep, we're going to talk about sweeps later. If it sweeps later, you're not going to get shaken out of it and get, you're not going to get scared out of the move and miss a massive move like this because you took the position all in at one go, and then it maybe made a little micro move against you, but that little micro move scared you out of it. So I would recommend scaling. That is what I found, especially as you go up in dollar amount. Scaling is just so much better to scale in and scale out. Mathematically it makes sense. Okay, mathematically it makes sense to do so. In this particular situation, we can just run through this trade, talk about it. Ideally you would have been taking an entry here in your zone, and then how you would scale that entry up is by identifying the range. So in this particular one, you have your opening range, right, high and low, and ideally what you would want is a break, hold, and close beyond the range to add to your position. So the ideal situation would be something like this, printing up here. It's what we call a break, hold, close, and that's where you would start to add into the position and continue to do so as the trade runs in your favor. Okay, so break, hold, close, and I want to highlight that point. The reason you want to wait for a break, hold, and close, and that's going to be at least a 15-minute bar outside the range. The reason for that is, imagine there's orders sitting up here like so. Okay, imagine there's orders sitting up here like this, and they exist in the form of sell side orders. Okay, like that. When that price pushes up, like it did here in this particular situation, it pushed up into this range. You can see it went flat there. It went flat, so it rallied, and then it based, and then it dropped, right? And you can tell that the price is kind of compressing there. The reason you want to wait for a nice healthy close above that level is, above this range, any range for that matter, is because those orders that are sitting up there, they need to be, in order for them to be eliminated, the candle has to close beyond it. okay? The candle has to close beyond the range in order to show you that there's no more sell side orders sitting there. It cannot close beyond this range without those sell side orders being washed out that are most likely stemming from over here, okay? So it has to close beyond it. Similar like this and like this, right? It's got to push beyond it in order for it to be valid, all right? So that's when you would get your ad, when you get a nice healthy close beyond it, and then you can start adding into your swing, okay? Moving forward in terms of where you're going to be exiting, the exit parameters are going to be the exact opposite. So when you identify your zone down here, right? Let's go back to this 4-hour chart. When you identify your zone here, you're looking for a nice A, what I call an A to B movement, okay? So if this was A to B, right? Well, I'm looking for the exact same thing. I'm looking for an A to B movement, and I want to take my exit in this range, like this, okay? I want to take my exit in this higher probability range where this is likely to turn around. Now, if you're over time, when you become a little more skilled, you'll be able to take trades and run them out from A to B, and perhaps even catch a pivot going the opposite direction too. But this is also why I've said you want to buy at least a few weeks on the contract, because even though this move initially only took 3-4 days, look how long it took to get back up there. It took quite a bit of time for that move to play out, okay? And as it gets up into that range, that's when you want to be scaling out of the position, okay? So A to B movement. Now, there's a couple other things I want to go over. So we're going to go through a few examples that we've done recently, okay? Let's start with, we can actually continue with Microsoft. We can continue with this. Notice what has happened here. Okay, we have our all-time high, it's sold off. Remember what I said about BFI adding and protecting their position and why these prices don't show up all the time? We took this trade here in early August, and look at what happened. When that price finally returned back to that origin of that BFI footprint that took us to the all-time high, look what they did. And like I mentioned at the beginning of this video, when that price shows up, whether it be long or short, it's going to be it's not going to feel good. It's going to be a hard trade. You're not going to want to enter it, because that's the structure and the way the market is designed. But ultimately, if you stick to the four structures that I gave you at the beginning of the video, and let's go back and look at what happened there when it came back to retest, right? So you have your drop, very strong drop. It gets into the zone, and then look what happens. It bases sideways, and then it starts to rally. And then that rally continues up. It continues all the way up until it finds liquidity up there at the top, and then it starts selling off. Now, I've been mentioning liquidity quite a bit, so I want to talk about that and how to identify it. So something that you're going to need to add to your chart is a volume profile, okay? Volume profile, and that's what this is here on the side. That's how we identify where BFI are positioning, okay? It's not just the impulsive move. That's when they make our job really easy, okay? They make our job easy when they do a nice healthy BFI footprint, and we can say, oh, they are positioned right there, right? That makes our job easy. But sometimes they don't make our job easy. And they're definitely not trying to, okay? Sometimes they make our job more difficult, okay? So let's talk about the times where they make it more difficult. Now, let's go to a recent trade that we did. Look at this volume profile here. And what you're looking at when you have a volume profile on your chart, you're looking at volume by price, okay? This is volume by time. This is volume by price. If you're in the community with me, you'll hear me talk about a point of control. This is the point of control. The point of control is where the highest amount of volume exists across a given time frame. Now, this is when BFI make our life a little more difficult. They're not giving us a very, very strong impulsive move like this one, right? Well, at least at this time, when the price retested, they didn't just pivot it and turn it around. So this is where that Wyckoff logic comes into play. The picture that I had up on the screen at the beginning of the video. You have to understand that the market goes through phases. It goes through a markup, an accumulation phase, a markup, a distribution phase, and then a markdown phase. Okay? So it goes through these phases. And this is where they tend to make things a little more difficult for us. But that's where our volume profile gives us an added edge, because even if they're making it difficult, we at least have an understanding of where they're positioned. Okay, so let's look at how this developed across time. I'm just going to use this little bit of this time period here. Let's go like that. Let's get this thing going. Oops, no, that's not what I wanted. Give me 1 second. Just want to show you how a volume profile will develop across time, or how the point of control, will develop across time, because it's very, very important to understand. Okay, we'll start here. All right, cool. All right, great. And let's play. All right, so let's watch how this develops over time. Let's speed this up. And what I want you to watch here is this volume profile on the side. And we're just going to watch it play out, okay? Because this is what you're going to be looking at in real time as price gets back or gets into a zone and starts to develop. And what you'll notice is you will see that volume as it's developing, right, like it is right now. Look at what's happening. Now you're starting to get what I call a multi-day point of control. Multi-day point of control. Okay. Now where you are in the cycle, you can start making decisions of where you think you may be in the cycle, right? Let's pause it real quick. Am I at a point in the cycle, if I'm looking at this particular chart, right? Where am I is a question you want to be asking yourself. Because you need to make a decision up here. Well, am I going to be long or short? Which one am I going to do? Am I going to be long or am I going to be short? Right? You need to be making a decision up here. And this is where sometimes it can get a little difficult. Well, in this particular case, you can look to the left and say, well, you know what? They sold it here, right? They sold it big time there. There's probably still orders sitting up there. Probably. And what's happening is I'm developing a range, right? I got a range developing. And I have what I call a multi-day point of control. And this is where they'll make, like I said, they'll make things a little bit more difficult, right? Now it's struggling to get outside of that range. But I know, based on the size of the orders, that BFI, let's go here, let's just make it a little tighter time frame. I know that they're trading here. I know they are because of the size of the orders. Now, if it can't break this range to the upside, it's most likely going to repeat, and this is going to be what we would call a rally, base, and then it should be followed by a drop, right? That's what we would expect. If it can't break upside, it's going to follow with a large drop. And now that we've started the monthly order flow to the short side, right? Well, after we get that first drop and it breaks range, well, they've made a decision at this point of control, okay? And the way this, I want you to write this one down. The way price moves away from a multi-day point of control, it is most likely going to continue in that direction until price finds liquidity, and then it will develop another multi-day point of control to pivot the position and go the other way. Okay? This is all about liquidity. So like in this particular case, some may see this first move take place and be like, oh yeah, maybe it's going to retrace. But once it's made this move to break a range away from a multi-day point of control that's been sitting there for 2 weeks, that's a decision. A decision was made to make that move, and it will most likely continue in that direction. And this is where you're going to get into those scenarios where you're going to have in this case, a drop base drop. So let's look how this played out. It drops, it bases, right? Let's pause it here. Let's look how this is developing on a smaller time frame. After the initial drop, look what's happening here. Look at this. Look at what's happening here. You have another point of control. Inside every base, whenever price is basing for an extended period of time, you're going to have one of these. That is what is naturally going to occur. And that's why those 4 structures are so important. The drop base rally, rally base drop, etc. It's in the base is where you want to be taking your trade. You want to be scaling into the trade as it wins. Okay? Now obviously the first retest of the BFI footprint is ideal, but you may not get a retest of this footprint because of how, if you didn't take this trade initially from this and you weren't able to recognize the structure, that rally base drop, then you're going to be in a scenario where you may not get the full retest, and it will just continue. It will be a drop, base, and then drop. So notice what's happening here as it develops this second point of control, and then you have a drop, base, and then drop again. Okay? Drop, base, drop. Pause there, all right? Because that's the end of today. So I'm going to go through a couple more examples of identifying zones, BFI footprints, and how we actually executed on these particular trades, and that will give you a little bit more of an idea of how to use this one. This was one that we did a couple months ago. This one worked out really, really well. I'll just take this off, reset the chart view. Okay, all right. So this was the view that I was looking at here. Okay, let's go to the 4-hour chart. Okay. All right. This was an excellent trade, and I was able to get everyone in the group involved. I really, really enjoyed this one. All right. Here's the view I'm looking at. Again, very, very wide time frame. Now I can see that BFI decided to break this out over here, right? They had this sell-off right there, and then they decided to break this out. Okay. All right, cool. Now price has rallied up. It's come back down. It retested here at this origin where we also had another BFI footprint from here. Notice the amount of volume that was here on this BFI footprint where this initial impulsive move took place, came back for a first retest, and then it rallied again. A nice healthy distance, 328 to 360, 30 points, so 10% move, right? So in my mind, I'm thinking to myself, okay, they have a position here. That's what I'm thinking. They have a position there that they're protecting. So let's put a line there. They have a position there that they're protecting. They're protecting it from over here where they decided to break it out. So that tells me, all right, they're obviously long from here, right? And they want to protect this position. Okay, cool. All right. So what do we do next? Now price has come back and has retested. So I have my two impulsive moves. I have my breakout level over here. And now I have this long period of consolidation. So here's something to keep in mind. BFI are always buying or selling. Okay? If they're not selling, they're buying. And if they're not buying, they're selling. There's never a situation where they're just not doing anything. Okay? I saw this setup and I said to myself, okay, this is interesting. Going back to that same Wyckoff logic that I showed you at the beginning of the video. The price has fallen, it is marked down, is distributed up here, and now it is just running sideways. Now most people, especially retail traders, most retail traders will look at this and say, yawn, boring, it's not going anywhere. I'm not interested in this. And the problem with that is that they would be, because they disregard the price structure because they don't understand what's happening, they don't execute on it. Now when I saw this, I said to myself, okay, it's locked in a range like that. I have a not only multi-day, multi-week point of control. Okay? Something to understand about the point of control. The longer the price, write this one down as well. The longer the price spends stuck inside a range where the point of control is developing, the bigger the price movement is going to be when it leaves that range. Okay? The longer it spends there in the range where the point of control is developing, the bigger the price movement is going to be when it leaves, because they are either accumulating or distributing a position. That's why we caught that big SPY short that I just showed you a few minutes ago. Same thing was happening here. Okay? This price it's a retest of a BFI footprint. It is consolidating or accumulating. I have my multi-day point of control. Now, how did we play this? How did we take this trade? We started by taking an entry. Where was it? It was about here. About here, right at the point of control. Because I said to everyone, well, they're not selling, because if they're selling, the price would be continuing down. So we took an initial entry here, and this is why this is great for the swing trader, because you can take a trade, or you can take an initial entry in a range like this. Okay, you know what? Let's go to a vertical line. Might be easier to see. So we took an initial entry like that at the point of control. And I said, okay, what we're going to do next is when price closes above these levels here, when price closes above this, that's when we're going to add to our position. Okay? When we start getting a break, hold, close above it. Now, I was also willing to take another entry on a sweep down here, but it just never got there, obviously. So we took the initial entry here, we added as it went in our favor, and then we added one more time after it completely cleared this range here at the very highs of these wicks. And then after that, we took our A to B movement. the same spot where they sold before. This is where we sold at. We sold right up in here in this range. Okay, so it was a buy, an initial entry. We bought 3 weeks or a month. Add, sell. And that's why you need to buy time on these kind of moves, because it can stay stuck in a consolidated range. And sometimes you may need to even do a particular trade twice. Like if it's really stuck there for a long time, it's like a low beta ticker, you may need to do the trade even twice if you didn't buy enough time or it was stuck longer than expected. But if you understand where you are in the cycle of the stock, yes, maybe you may take a paper cut by maybe you took an initial entry over here when it came back to retest and it swept this low, right? And you didn't buy enough time and it just, the trade didn't work. But maybe you're a -1 on the first go around, but the second one, you get this big markup phase, which is what you're trying to get yourself involved in a markup phase. That trade will deliver, I can't remember what we had, but it was massive, 4, 5, 6, 700, 800, 1,000%, depending on what contract you're on. I want to bring that point up as well. When you're trading, in my opinion, you should be taking an at-the-money contract. Okay. Once you've identified your zone, right, like these base to wicks here, right, so this will be like a 325 strike. You want to be taking an at-the-money strike. That's going to be a good risk management parameter to just have at all times. Because if you do that, even if it makes a move against you like this, like it does a little sweep, and you're only partially in, you're not going to get even if you're fully in, you're not going to get obliterated. Whereas if you were on like a 335 or 345 or something like that, and you're way out, and it makes a move like this against you, that'll destroy the contract entirely. Okay, so all right, that's a little risk management parameter. I also say to the group when they're scaling their entry, all right, and they're scaling based on the levels that we have. So we're looking for those break, hold, closes above outside ranges. We want candle closes and signals outside of there to signify, okay, this is going to be a good, good setup for us. I tell them to scale in quarters or thirds. So quarters or thirds, and you don't add to your position until you get the next signal telling you to do so. Okay. And you will notice amongst retail traders, and this is a little bit of psychology here. Retail traders are very, very timid and scared to add to a winning position. And that is the exact thing that you need to do in order to grow your account exponentially. When your trade is winning, you want to be adding to your winning position. And I'm not saying add late. I'm not saying you get on a big move, something like this, and you're, hammering the position way up here after it's already made a move. That's chasing. That's different. What I'm saying is when that trend starts to begin and you start getting those breaks and holds and closes above particular key levels like this and this, outside range, etc., that's where you want to be adding and growing your position. So that way your winning positions are monsters. Okay? And you really have to do that. So this was one nice A to B movement. Let's go look at another one that we recently did. Let's go the other direction. Let's go short. We ended up catching both sides of this trade, but I'm only going to focus on the short side here. Okay? We took this trade here from 181 up to 200, and then we went short. All right. How did I identify this short? Because once we got up here, we were at all-time highs, right? So there's not really much structure up here. We took the short about here in the center, again at the point of control, off the 200 level. So again, there's not really a lot going on there, but what I did have is after we closed our longs over here, we close it on this last shove up, right? Look at what happened next. I have this very healthy BFI footprint that's taking place. So I said to the group, I said, okay, when we get back to this zone, or this range, I want to be looking for signals to go short. So I have a BFI footprint. I know that they initiated a sell side order. Okay, I know that that took place. Let's wait for what? That first retest of the origin of a BFI footprint. Okay, so at this point I only had this. So I'm going to go, all right, this was the origin. That's the price that initiated the sell side order. And then I also have that high. So I see it push up above, right? And let's go real time. So that way, let's do a replay. So that way you can kind of see what I was thinking at the time, and you can get a little bit better idea of how that trade developed. Let's get this going, because I want you to see everything in terms of signals and all that, and just kind of talk you through it. Okay. All right, so let's go replay. Let's go from here. Let's get it going. All right. Pause here. What kind of structure do we have here after it makes this large impulsive move? It rallies up, rallies up, rallies up, and then it runs out of steam, where we took our final sale in this base here. So it's rallying and then basing. And that's one of our key structures, right? So I want you to be able to identify this in real time. We didn't take this first short, we took the second one. Because again, like I told you, I didn't have any structure up here. I just was trading subjectively. But the next trade is mechanically. And that's how I want you guys to be trading. You should be trading mechanically. You should not be trading subjectively. So it's, you have your origin, you have your zone, you have your signal, you take your trade. Okay? 1 second. Okay. All right, let's continue. So now I get this very strong impulsive move south, right? So I said, okay, that's a BFI footprint, guys. Let's wait for it to come back to that zone. Now this zone was pretty tight, right? That's the price, that was the high, and this was the price that initiated the sell-off. Okay, so that's what we would say is the origin. So it's the most valid pricing, 199.25. Okay, so I said, all right, let's wait for it to come back up here, and then we'll give it a, we'll potentially give it another shot. We'll see what happens. Let's play it forward. Now I want you to watch something here on this point of control, how this develops across time. Okay, I want you to pay attention to this. All right, so it comes back up to it, to that price. It rallies up to it, finally gets there, and then it bases out. It doesn't, yeah, it pushed a little bit past it, but look at how weak it was, the way it pushed past it, right? Next day, you get another drop. So at that point, I said, okay, we got a short. We got a short setup here. Comes back again, right? Now let's pause the video there. Look at what's developing here on the side. Look at what's happening here. So I know that BFI are trading right here. What this signifies to me is there is a large amount of liquidity sitting up there. So there's a lot of people buying in, a lot of people selling. So then I got to ask myself, right, where am I in the cycle of the stock? At what stage am I in? Am I in an accumulation phase? Am I in a markup phase? Am I in a distribution phase? Or am I in a markdown phase? Well, we just had a strong rally, right? We just had a big rally. We took this from 181 on up, right? just so you know too, I applied the same exact principle down here when we took this long. I just came back and retested the origin of this BFI footprint, and I took that long there, right? In that zone. You can see what I did there. I printed a pair, and I went for it. Anyways, let's get back to the short. So it just marked up 20 points, 10% move up. I just got a BFI footprint here, and now I'm getting a rally base and no more upside movement. And I'm developing a point of control, right? And that point of control, that's, if you were trading, even if you were an absolute donkey, and you did nothing but make trades based on the way the price moves away from the point of control, you probably could be profitable. If you ignored everything else in this video and just did that one thing alone, you probably could do really well. Okay? All right, let's see how this develops. Look at what's happening from a liquidity perspective here. Look at how this point of control, look how strong and prominent it is. So at this point, we have taken a pilot. We have multiple failed breakouts. It keeps trying and failing. Tries, fails. Base, base, base. For days. And like I said, the longer it spends stuck in a particular range, the bigger the move that's going to come when it leaves that range. When it leaves that point of control, the longer it spends there, the bigger the move it's going to be. Okay? So let's look how this plays out. Look at what's happening here. And there's your, all right, so now we got action, right? So how did we execute on this? Right? Took the initial short here in the center. It's in one of these bases. I can't remember which one. Okay, took the pilot and I said, okay, when it leaves this range, we're going to add to it. So it finally left the range and I added to there and I took the full size. Nice and simple. A to B movement now. So if I went A to B, right? Well, if I bought enough time, I also want to go A back to B. That's where we want to go. Okay? And again, this is designed for someone that doesn't want to sit at the computer and just stare at it all day. This is the nature of swing trading. Once you take the entry, you allow it to run to target. And you don't click the button until it hits the target. I mean, that's it. You buy enough time so that way you give yourself enough time for it to play out, and you click out when it gets to the target. Okay? So let's watch how it plays out. In this particular one, I did this trade twice because I took this initial drop, right? And then now we have a drop base. What's likely to come after it makes a move away from the point of control? Well, I just showed it to you on SPY. It just moved a large move away from this point of control south. The monthly order flow now is bearish, right? And I told you the monthly order flow determines your high and low probability trade. The monthly order flow is flipped bearish. I can see a clear markup distribution and then now markdown phase starting. So I have a drop base, and then you're going to get another drop. It's going to leave that range. And just let it play out here. And we ran this trade twice. We did this first drop, and then we reloaded and repositioned and changed strikes, and then we ran it out to target. And look, it went all the way back to the exact same spot, and in fact, even farther. I ended up closing out the last of it down here because I'm like, all right, target's acquired. That's it. We'll wait for the next setup. Okay? So this is a great example of exactly what I'm talking about. But actually, let's pause that real quick. Notice what happened here when this price, after we did this A to B movement, look at what happened when it came back to the first retest of the origin of the BFI footprint. Look at what happened. Now, at this point in the video, this shouldn't be coming to you as a shock that this occurred. Okay? The whole point of the BFI method, too, just so you know, is that it gets you in first. That's the point. So the reason you draw these zones and you enter in these zones is because they're the highest probability where the trade will work out, and it's also going to get you in before everyone else. There's only 3 ways to win. You can cheat, you can be smarter, or you can be first. And this method, you notice I don't have any indicators on my chart. There's no indicators because there's no indicator in the world that's going to tell you to get in here now. Because the indicators, they wait for the price to develop before they give a signal. Okay? And that may seem a little aggressive if you're not familiar with this, but just so you know, this is how BFI trade. Think about it. Do you think Goldman Sachs or JP Morgan is sitting there waiting for some indicator or MACD cross or something silly like that to occur to tell them to get in or out? No. No, of course not. They're not doing that. They buy and sell at the level. But the thing with them is their orders are so massive, they can't just click the button like we do and just buy or sell. So that's why this point of control is so important, because they accumulate and distribute positions across multiple days, sometimes weeks or months at a time. Okay? All right, let's move forward. That was another good example. Okay? We can use this one too. This was one we recently did. Let's go to the 4-hour chart. This one was nice and clear. Very, very, very simple. Simple trade. You had to zoom out and get on quite a bit of a wide time frame to see it develop. Okay. All right, so we'll just go from there. Okay, cool. Let's clear this chart up. All right. Now in this particular one, this one was a tiny bit difficult, a little bit difficult to execute on. And this is where I want to bring you to this idea of liquidity sweeps, okay? Because this is the other tool that BFI love to use in order to get the liquidity that they need in order to execute on the trade, okay? Now, like I told you, BFI operate on very wide time frames, okay? Let's just use this. We'll use this time frame because this is from where target has gone bullish, okay? All right, let's get this going. Now, we have this big impulsive move. We have this big rally. It pulls down, it marks down. Now, I was watching this particular trade for a very long time. I saw this price mark down, and then I saw this BFI footprint take place here. So all I did was I utilized our method. I said, okay, I'm going to go base to wick right here. So base to wick. That's my zone. That's what I'm interested in. Now, on this particular one, I ended up actually missing this trade here. I didn't take this entry because I was doing something else. Okay, you can see how it played out. Obviously, it worked out really well. Whatever. I'm introducing you now to this concept of liquidity sweeps. I missed this trade, so I said to myself, okay, in the group, I said, okay, I'm fairly certain that BFI have a position here because of how they've done this movement here. I know that they broke it out over here and pushed it up over this range here, right, where this final sell-off was, and it add these last origins over here. Okay, we had this high here where it couldn't get past in the past. Final sell-off, drop base rally, breakout. It pushed past. Remember what I told you about add to the position and protect the position? When we took these trades here going on this long leg, when they made the decision to push this past 133 from June of 2023, we can assume that they have a large position, most likely sitting down here, right? They have a large position down there. So if they're going to protect that position, well, the way that they do that is when price approaches their position, they're going to add to it, because they don't want price to continue down into it, because then people are going to start selling and start turning them red. They don't want that. So they're going to add to that position. All right. So now let's introduce the concept of liquidity sweeps. Okay. So I said to the group, I said, all right, when it gets exactly back to this origin, at the origin, I'm going to take one entry. I'm going to take an entry. It's probably a bold entry. Took the entry. Said if it gets to that origin or sweeps it, and what I mean sweep is that the price goes under this low. Now, why is that important? For BFI, they're dynamic traders. The best way for them to conjure up liquidity is by pushing it just enough to the point where they can trigger a pool of liquidity. They can cause people to go short, and they can cause people that were long to stop out. And those stops and those entries are very, very often in the most obvious place. People don't, as a majority, don't do they don't, they do it in the most obvious place and obvious way. So my entry is literally their stop loss. So I said, okay, when this price sweeps here or goes at this origin and signals, I'm going to enter. Because in my mind, I'm assuming that their stops are going to be sitting there. Anyone who's entered during this entire period, even if you caught the very bottom of this, when the price goes beyond it, if you got to stop, where's your stop going to be? It's going to be right underneath that. So I'm going to take the entry there, because I want to enter where BFI is going to enter, and they're going to enter where your stop is, right? Okay, take the entry, take a pilot. I bought a month. It does nothing happens. Next day, gaps down on me. Okay, whatever. I leave the pilot. Let's see what happens. Let's see what happens here. Let's go from here. Let's replay this. I want you to gain an understanding of what I was thinking at the time and how this played out. So look what happens here. A little bit fast. Look what's happening here. Let's clear this chart so it's easy to see. Look what's happening down here after it sweeps. So it hits all those orders, okay? Hits all those orders, and it gets down here. And then it's stuck in this range. And this is not very attractive for most retail traders, but look at let's exit this, let's go back. Let's replay this a little bit slower so you can see it developing. So look how this point of control develops here. Now, based on what I've just shared with you, right, they're adding and protecting their position. You know they have an origin here. And that's what I'm telling you about how they operate on very wide time frames. This was the price that took it to here. That final pullback and then spring higher is what took it there. This was also the price that they decided to add to and protect after they broke it out over here, right? That was the price. Like, look, it's almost exact to the penny. That's the price. So when that price comes back and gets here, well, look what they ended up doing. They're adding and protecting their position. And then you're getting that first retest of that BFI origin. And then let's look how this plays out. After this, let's talk about execution. When I took the entry here, Once it developed the point of control multi-day like this, and I zoomed out, I told the group, I said, hey, I'm adding to the position here, and then when it breaks out of this range, I'm going to add more. So that's exactly what happens. I added here, breaks out. Next day, I ended up adding at the open, and then look what ends up happening. And I get this massive win off of this move. Now, it doesn't come as a big shock to me because oftentimes great setups, a drop base rally, occur right before a catalyst that's going to be favorable. BFI already know what the catalyst is going to be. They know what they're going to do. They already know. This is not a secret or a surprise for them that they're doing it. This is where the liquidity was found, and that's where they accumulated the position and added to it to protect that position that they've built up and protected since December of 2023. And that's why I said this method, you notice I have a full list of stocks here. These prices don't show up every day, but when they do show up, that is the time to execute. They don't show up every day, but when they do show up, it's time to execute. So this is for the patient trader, the professional trader, who can wait and wait and wait and be patient for the right setup. A first retest of a BFI footprint or liquidity sweep, a drop base rally. As long as you're operating within these structures, you're going to find yourself to be very, very profitable. Okay? So that was your first introduction to liquidity sweeps. Let's go over one more that we did. This one was also on the long side. This was Tesla. Okay. Now let's talk about this. All right. We had this liquidity sweep down here. I called a long entry down here in the 140s. Take equity. Okay. Now, let's zoom out. Let's go to our monthly. Let's get going here with our zones. Remember what I told you about base to wick and the origin of the BFI footprint being very important? Okay, you got this base to wick down here on Tesla, right? 1, 2. It never comes back there at this point. But then you also have this monthly zone here. 1 and 2. Okay? And that was the zone that caused the price to rally up to this 300 level. Now, it took a very long time for this price to come back to it, right? And that's why I said this is for the patient trader. And it goes both ways. Just remember that. It's long and short. So, it's not like you have to just sit here and wait for the long side forever. You can take the short side, just as easily, just like this, right? There's your BFI footprint there on the monthly. Well, look what happens when it comes right back to that same zone. You get the same move, right? When it comes back up here again, you get the same move again. Like this, this one line, you could have done a lot of damage with this one line 3 times. But, it takes time to, you may only be taking, a few trades a month. Like for my swings that I call out, I only do maybe 3 to 5 a month because of how wide these time frames are, right? And but if you're in my community, you will see, you'll see how that works out. Like, yeah, I'm maybe not trading the exact same ticker every day, but that's why I have a pool of tickers that I follow, right? Because maybe this one's there in a zone, or maybe that one's not. Okay, I can trade this one or that one or what have you, because it's at a zone. So let's talk about this long trade here. So it comes back to this monthly zone here. I call an entry. We take equity. And I say, okay, cool. Now, let's look what happens after that. Okay, let's go to the 4-hour. So they added and protected that position, right? They added and protected that position. Okay. Big move that occurred. So, rally, base, rally, right? Left behind a price inefficiency here in this gap. Came back down, filled the gap. All right. Had another BFI footprint here. And I said at that point, I'd been talking about it for weeks. I said to the group, I said, hey, we're in an accumulation phase. We're stuck in range. When we sweep this range, because I'm assuming BFI are long here, let's get rid of some of these lines just to clean it up a bit. I'm assuming BFI are long. I want to take a pilot entry and get this trade started. I have a multi-week point of control that's developed. When this price sweeps these lows, I want to take an entry and then add to it as it becomes favorable. Okay? I talked about this trade. I was foaming at the mouth for it for weeks. All right, finally it plays out. Look what happens. It sweeps. Take entry on the sweep. And then look at the monster how this follows through. Again, these great setups, these drop, base, rally, rally, base drops, they come before a big move. And oftentimes there will be a liquidity sweep right before a big move. And that liquidity sweep will be an opposite move. So notice what's happening here. I'm going to that lower time frame so you can see the signals and the structure. Look at this. Drop, base, rally. Drop, base, rally. Okay? Accompanied with a let's go back to that 4 hour, a multi-week point of control. Okay? So again, it's identifying where BFI are trading. You identify that by using the point of control across multiple days. And then you make a decision based on where you think you are in this cycle of the stock. Once you get your retest at origin, you take your entry and then you start scaling up on the break, hold, and close of the candles over your key levels. And then you hold it for an A to B movement. Right? In this particular case, are you shocked? Are you shocked that this price, when it sprang off of here, that it sold off? That was the top here? You shouldn't be, because that's the structure that we operate within. This is your accumulation from the picture I gave to you at the beginning of the video, and this is your markup phase. Then once it gets up here and you get this first retest of this BFI origin, look what happens. The first time it taps it, it just sells off immediately. Right? Instantly. There's not even a wait there. And they distributed it for a few more days before they continued to mark it down. Okay? So biggest key takeaways here. I think I've illustrated the point enough times for you. Write these down. The first retest of the BFI origin is the most powerful. You want to be taking your signal. Ideal signals for you are going to look like so. You want to have a signal and structure. It's the ideal situation. Ideal situation, so you have your structure. I'll just continue with this example. So this is a liquidity sweep. You have your drop base rally setting up, right? So let's look at one that's not a liquidity sweep perhaps, just so it's a little easier. Just go back to this. We can use the long side, it's fine, doesn't matter. You're looking for these high volume pin bars like this down here in zone. Let's clean the chart up so you can see it more clearly. This is your number one signal to look for. High volume pin bars at the top or bottom of a drop base rally or rally base drop. A secondary signal may look like a doji, like so. So pin bar being number 1. Let's say this would probably be a number 3 in terms of signals. The number 2 would be like a bullish engulfing candle like this guy right here, where you have a drop base and then you get this very, very strong. This is a decision being made. Okay, so those are the type of signals that you're looking for. You're drawing your zones base to wick. And you're monitoring the multi-day point of control. And then you make your decision on where you are in the cycle of the stock. So those are the key components. So identify the BFI footprint. Mark your zone. Once the price enters the zone, when the signal closes, wait for the candle to close. Take the trade in the deeper side of the zone. From there, you're going to be adding to your position as it moves in your favor. You never add to a losing position. So if you sometimes you have what's called zone wipeout. Let's talk about that actually real quick. You have zone wipeout. So let's use an example. Okay, say like this, right? Oops. 1 second. Go back to that. It's all right. We can use this. This is fine. So say you have this BFI footprint here, right? Maybe you want to take a trade. Maybe that's your idea. You want to take a trade off the origin of that BFI footprint, right? You can see how it responded there. There was potential, okay, maybe a drop base rally. So how would you identify a zone wipeout? So like all right, this trade's not going to work, is when those candles, like it did it the next day, they're closing beyond the origin and the baseline of that footprint. And that's telling you that this trade has been invalidated. Okay? That's how you determine that. And that happens on both the long and short side. Okay? So when you get candle closes beyond the origin and footprint like this, that's typically how you would identify a zone wipeout, right? So first retest, that's why the first retest is so important too, by the way. That's why it's so important. Because if it's not a first retest, it's not going to be as strong. Like you can see how this kind of hesitated here at this. It based there right as soon as it came to that origin, and that's because there's a bunch of buy orders there. But ultimately, there wasn't enough for it to hold it to hold that price up. You know, and that's because it's not a deep value price, if you will. You know, it's not at like a monthly zone, which are the strongest. And I would encourage you to take the majority of your trades, especially when you're swing trading, take them at the monthly. If you take a monthly entry, very, very rare that that's going to fail. It's especially on the long side, very, very rare. Okay. I'll give you actually one example of a monthly that we did a while back on Apple. Let's go to the monthly. This was actually, I really liked this trade because I really spent a lot of time on the monthly for this one, and it worked out really well. I want you to just look at what happened here. Here's my monthly range that I was analyzing. I have this sell side up here, and I have this buy side down here. Nice and simple, base to wick. Very simple. Are you shocked that this price did this when this price came down here? It shouldn't be. Because it's rare that monthly zones break, especially on the long side, like I mentioned at the beginning of the video. Very rare that they break on the long side. So if you have price protection, like they made a decision to break this out here, and then when it came back and retested, they popped it. So when it comes back again, they're most likely going to add and protect that position. If you go back and look at Apple during April 1, 24, you will see a multi-day point of control developing down here and multiple signals on the 15-minute time frame and then you have your markup. So this is your mark distribution and mark down, and then you have your accumulation and then mark up. And that's where you want to trade. You want to trade at these extremes. You don't want to be trading as much in the middle. You want to trade where the probability is the highest, and the highest probability is going to be found at the monthly zone. Okay, so first retest of BFI origin, ideally in a monthly zone. Scale your entry, add to your position on break, hold, close of range, moving to the up or downside depending on which direction you're going. You're focusing on A to B movements. So if your target's here, to the upside. If your target's here, you want to be buying enough time that it has enough time to make the move. How can you determine how much time you need? At a minimum, in my opinion, you should be taking at least 3 to 4 weeks when you're getting started. You could probably just leave it at a month just to make your life easy. You can measure how long the stock has taken to make that kind of move. Like I wouldn't want to take a trade. Let's say in this scenario, right? It took a month for it to go from here to here, right? So if that's my target from 170 to 190, I don't want to buy 2 weeks. I want to buy at least a month because it took a month last time to make that move. Okay, so that's how you can gauge your measured move. Also, you can also use the ATR, average true range, just to get a gauge of what's expected in terms of volatility on that particular stock across a certain time frame. Okay, so first retest of BFI origin and zone. Signal, scale entry, add to the position, average up your winner, never average down a loser. A to B movement, buy enough time, take the first retest. Ideal entries are going to be in the monthly zone with a multi-day point of control. If you're doing all of those things, very, very hard for you to lose. Very hard. That's your checklist. Okay? That's your checklist. Now you're not going to be taking as many trades, and your trade entries are going to be relatively aggressive because you're going to be entering in these price levels that don't look, you're going to be going short here and going long here. It's going to take some mental effort to do that because it's going to look like, no, this is a terrible time to do it, but that's the exact time where you want to enter. Okay? So that's your checklist just to get you started, and that's the end of this crash course. And then we'll continue on with next step after this. Message me if you have any questions. Close this video out on that note.